How much of a correction are we still due in European stocks, given this rampant inflation?
Yeah, so we're probably more on the side of we haven't finished this bear market yet. I was listening closely to what Christine said there. I also agree with her point that you can't trust these rallies at the moment. Our view is that valuation is still not quite cheap enough. Europe is a lot cheaper than the US, but the US is the market that really matters for setting the tone, and the valuation of the stock market there isn't particularly cheap, not even versus the last 10 or 20 years. So that's a constraint, I think, still. Rates, obviously, Christine covered that very well. You've got higher interest rates everywhere, really. Very hawkish central banks want to fight inflation still. Thirdly, I think you have still deterioration in growth. That's absolutely what central banks want to achieve, growth to come down so that they can fight this inflation. And then lastly, I don't think people have got bearishly enough positioned. And there's some signs of that. There have been lots of outflows from European stocks, but we've still had inflows into the US this year. So my view is we're not quite finished with this bear market yet.
Sharon, you're absolutely right. These rallies that we do see do look very, very fickle indeed. So what are the conditions you're looking at then to get a sense of when that trough is there in a material way?
I think probably the key things are, one thing I think that's kind of necessary, it's not sufficient to get the market to turn, but I think it's quite necessary, is cheaper valuations, particularly in the US. The multiples that we're on at the moment are still quite stretched. They're not as elevated as they were a year or two ago, but a PE for the S&P 500 of sort of 17, 18 times forward earnings is not especially inexpensive. So I think you need to get a little bit cheaper. When you have previous troughs, you were generally at lower valuations. And then the other thing is people need to be confident that the rate hiking cycle is coming to an end. And I think we are some way from that.
So what exactly, Sharon, is priced in at the moment in European equities?
So Europe, I do think, looks cheaper. Of course, I think you need to see a turn in global markets, and that really depends on the US. But Europe, I think, does look a lot more inexpensive. And the reason for that, of course, is that Europe has suffered from more problematic economic environment at the moment. High energy prices, very much a bigger spike in inflation, that hit to real incomes. The geopolitical risks are really centred around Europe. I think in the way the European markets performed, it seems to be discounting or implying growth slowing, but not a real recession yet in there. If I look at the way the markets perform, then it's sort of implying PMIs, the Purchasing Managers Surveys, in the high 40s, which is kind of where they are at the moment. But I think they could dip a little bit lower. So again, I think the European market's a bit vulnerable too. I wouldn't expect another 20% down in shares. I think that is quite bearish, particularly on European stocks. That would send them down to the kind of valuations they were on in the financial crisis. But a little bit further down, yes, I think that's the risk.
OK, so Ray Dalio may be being a little overly bearish with that 20% call on downside for equities. Is there a play, Sharon, around European equities, stocks, companies that have sales exposure to the US on euro competitiveness?
I absolutely think there is. So the euro's collapsed, sterling's collapsed, and I think there's still a little bit of downside risk to those currencies. But absolutely, I think the companies, and this is one of the reasons actually European earnings in aggregate for the overall European market have held up quite well. There are so many companies with overseas profits in Europe. European companies are super international. Around, I think, slightly more than half of European company sales are made outside of Europe, with a very large proportion of that in dollars. So the companies with a lot of dollar exposure, those are the companies that will be gaining. Either they're gaining just because they're translating back all those lovely dollar profits into euros or sterling, or maybe they produce stuff in Europe, it's slightly cheaper, and then they can export it to the US and again make dollar earnings. So absolutely, I think the companies with a lot of international profits are doing relatively well and will probably continue to be.